don't get too down. Welcome, Michael. Thank you for coming.
Hey, Julie.
Hello, how are you?
Fine, how are you? Let me get my camera going here. Okay.
How are your exams? Hi.
Hey, how are you?
I'm good. How were your exams? Knocked them out totally awesomely, I'm sure, right?
Yeah, I get immediate grading, so I did pass both parts. So
congratulations.
Thank you.
Congratulations.
Thank you.
For those of you that don't know who I am, I'm 𝗲𝗍, and my group that I host is Pitranomics. And what I try to share are the strategies that my family and I have used for growing, protecting, and preparing for transferring wealth. And we have tonight Michael Ross. He is, like he said, he's an accountant, CPA, but he's got many other credentials. I met Michael Ross because he was hired, I don't know how I say this, as a forensic accountant during a legal dispute that I had. And I just fell in love with his expertise, his willingness to explain to me what was going on, the way he broke down a very complicated financial situation that I was in, and his guidance on making sure I don't do such, get into such a situation in the future, as well as strategically growing my business and organizing my business from a tax perspective, from a business perspective, rather than just a reactive position with regards to taxes. So I think he's absolutely amazing. He's very intelligent, he's very thorough. Please take this wonderful opportunity to ask him some questions once he gets a chance, to tell you a little bit about himself. And just know that I feel he's like the magic bullet to a business. A lot of people don't want to spend time with the boring tax stuff. It can get detailed, but it is what saves your business. So without further ado, the wonderful, the amazing Michael Ross, thank you for coming.
Thanks for having me, Julie. Were you going to go first and just sort of, did you want to talk about some of the things that you've been thinking about, or did you want me to go first?
I'd like for you to share just a little bit about you and your background, particularly that you have real estate experience. And then I will, if you don't mind, lead some of the direction and questions, and then other people can ask questions as well.
Sure. So first off, I just want to mention that I've been practicing public accounting since 1989, coming up on 4 decades of experience. It's been phenomenal experience. I started out with a back then Big 8 accounting firm doing auditing and taxation work. I then moved into working in private industry as a chief financial officer controller, which was excellent experience, believe it or not. It was nice to be involved in a business where, you understand the perspective from entrepreneurship versus just, financial, accounting, auditing. And I've always been interested in entrepreneurship, even going back to when I was in school. And that's because I grew up in a family that was, they were entrepreneurs, predominantly real estate entrepreneurs. My dad had an apartment rental business. My mom was a licensed real estate salesman in Connecticut. My uncle was a real estate salesman broker. My grandfathers both were real estate investors, investing in single family and multifamily properties. So I got, just by virtue of growing up in it, I got a lot of, I used to work for my dad. And I used to work for my uncle when I was in school, and I would get a lot of different perspective on real estate, which I think has helped, me be a more informed accountant. As mentioned, last several years, I've been focusing my practice on really the forensics area. And when you talk about forensics, it usually relates to litigation. I also do a lot of work in the fraud area as well, where you might have people that are partners in business, and one partner takes out more money than the other, or tries to hide it, whatever. There's various kinds of fraud that are perpetuated. There's commercial fraud, and then there's things like divorce forensics, family law, things like that. So I do mostly divorce forensics and commercial forensics, typically where there's a problem in a business. I also started doing a lot in the valuation area. I'm actually in California, and as you may know, cannabis is legal out here. I started to see some demand for cannabis properties, cannabis valuations. And it's actually kind of a cool area because it's very new. There's not a lot of comparative businesses, even though there's a lot of people in the market. It's such a new market that it's hard to find reliable information for which to apply valuation methodologies and approaches. So it's just an interesting area. Anyway, so the bulk of my practice today is in the forensics area. I find it to be very interesting, and I see that there's a lot of opportunity there, especially because businesses are becoming more complex. The economic environment is becoming more complex, and we've sort of become a very short-sighted country. It used to be that you would rely on the long-term fundamentals of business. Today, everything is short-term. What are we doing to make this quarter better than last quarter versus what are we doing today that's going to impact us 5 years from now? And so we've become, as a society, more short-sighted, and this presents unique problems in terms of competition. And in many cases, this competition is so fierce that people try to take shortcuts, and those shortcuts end up creating legal and ethical dilemmas for business. And that's where, my services kind of are driven from that. I did want to talk about a couple of things today. I want to talk a little bit about current events, things like inflation, things like the stock market. I did want to talk a little bit about taxes, not so much specific tax laws per se, but many of you have been probably reading about the IRS being very much behind. Some of you may be waiting on refunds. So I wanted to just touch on that a little bit, but I mostly wanted to talk about the inflation in the stock market. Recently, if some of you have 401ks or IRAs and you hold stocks in your account, you're seeing that the market is off 20%. I want to talk a little bit about that, but I first really want to talk about inflation and, what does it mean, and what are the causes, what are the effects, and what should be a strategy from an investment perspective. There's many causes of inflation, but primarily it's basically when there's too much money chasing too few goods. And what happens is people have money and they're spending it, and the supply of goods may not keep up. So people are bidding up the price of those goods and services. And that's really what inflation is. Now, there's a few reasons why we have inflation. And I would say that most of it has to do with structural issues. And I'll talk a little bit about what I mean by that versus Fed policy. So what happened is the pandemic started and a lot of people got laid off and they were not productive, okay? Well, the Fed, in an effort to improve employment, said, we're gonna do all this incentive. We're gonna give all these incentives, or we're going to start buying asset-backed securities like mortgages in an effort to increase the supply of money. So what happened was the Fed increased, and this was in the trillions of dollars, increased the money supply and got it into the hands of people that weren't working, so they weren't producing. So you have all this money in people's hands, people aren't producing the goods or services because they're unemployed, and we have all this money chasing too few goods. In other words, less goods on the market, more money, inflation. But the question is why are we starting to feel it now? Why didn't we feel it back then? Well, the problem is that there is a lag time between Fed stimulus, or what they call quantitative easing, and consumption and whatnot. So basically, the inflation that we're seeing today has to do with too much liquidity by the Fed. And that is just a Fed action, okay? But we also have other problems. We have things like structural issues related to the supply chains. In other words, there's too many goods backed up at our ports of entry, and they're not getting into the market. And people are having to wait an awfully long time for those goods. Well, the thing is since there's a shortage of goods, people are bidding up the price of those goods, and we have inflation. And you're starting to see some of this, like when you go to the grocery store, you'll see that companies are making things in smaller sizes. In other words, you're paying the same money, but there's just less contents of goods. That's one way. The other way is these companies are raising their wholesale prices. Therefore, we're going to end up having to pay more. So we have, as far as structural, we have two issues. We've got supply chain. We have, and now we don't have enough. We basically have too much. Let me rephrase that. Part of the structural problem with inflation is there's not enough workers. There's not enough workers of the kind that we need. For example, truck drivers to take the goods from port of entry and deliver them to the rest of the economy. So we're seeing that as a structural issue, which is basically lack of people. Another thing that we're seeing is commodity inflation. Things like oil is going way up. Also, things like computer chips are problems, because you probably read that the automakers aren't able to build as many cars because they don't have the chips they need to put in the cars. This is another example of how certain commodities are and the lack thereof are contributing to inflation. Certainly the oil prices have gone up very quickly over the last 90 days. I mean, out here in California, I think I'm paying $5.75 a gallon for gas. Now, it's just crazy. What is it in Texas, Julie, by the way?
The last time I filled up for premium, I think it was like $3.59 a gallon. and I was
Yeah.
completely empty.
Yep.
But I believe it's gone up since then. You know, Zeus is a hungry bear.
Right.
And there are a number of realtors on this call. And so inflation, and I don't really consider it appreciation. It isn't that the relative value is improving so much. It's that inflation has really hit, short-term inflation has really hit the real estate market. And people are scrambling now to secure homes for buyers. And sellers are cashing out in big ways and probably not sure where to put their money. But I think that's a spot on topic to be discussing, and recent events aren't going to help. So I know it seems like, hey, does that really impact us? Those events going on across the ocean? And I'd like to say yes. And let's talk about what that lag time impact might be. Just like we're seeing very strong impact now from things that happened 18 months ago. How do we prepare, Michael? What should we prepare for? What's going to happen 18 months to 2 years down the road?
Right. So the Federal Reserve Bank, okay, which is the bank of last resort, it's the Bank of the United States. Federal Reserve basically has two objectives. One is inflation targeting. What do I mean by that? The Fed has an objective where they don't want inflation to be more than 2% annually. So what they do is they control the money supply, both the money supply and interest rates. You all have probably heard about the Fed it's anticipated that the Fed's going to raise interest rates between 5 and 7 times over the next, I believe, 18 months. And they usually do it a quarter of a point, 0.25% of interest. Sometimes you'll hear that mentioned as 25 basis points. 100 basis points equals 1%. So when you hear the Fed say 25 basis points, they mean 0.25%. So one is making sure that interest rates are low, and or that if inflation picks up, they can raise interest rates. The other is maximum employment. So maximum employment often comes about between toggling the interest rate either up or down, or increasing or decreasing the supply of money. So the thing about interest rates is that they're very low. They're almost near zero right now. For the Fed to increase rates 0.5% is just not very much right now in the overall scheme of things. Now they're talking about only that the first rate hike is going to be 25 basis points or 0.25%, because of the uncertainty surrounding the Russia-Ukraine crisis. The other thing that I should address is the Fed, in terms of maximizing employment, the Fed wants to make sure that everyone who can work and wants to work has a job, and that wages are keeping pace with inflation, so there's an incentive there that the Fed can, if the Fed sees the economy over racing or it's too hot, the Fed's going to raise interest rates. If they see, and or the money supply, if they see that the economy is slowing down too much, our gross domestic product isn't achieving goals and growth, then the Fed will go ahead and decrease interest rates and increase the money supply. So anyway, Julie, I'll hand it back to you and to comment, and I'll be glad to kick in whenever.
Well, thank you, Michael. And I have suggested anyone that has comments or questions to please type them in the chat. But one of the things you mentioned is that the Fed is interested in ensuring that through their monetary policy, that wages keep up with inflation. Mm-hmm. I think for people like us who are worried about growing, protecting, and even transferring wealth, you want to make sure your I guess your accumulation value keeps up with inflation. So currency, understanding exactly what currency is and what it should be doing is an important mindset to get into. So I had a grandfather who felt like a way to save money was to literally save the notes. But the notes don't mean anything if there's runaway inflation or if there's a currency disturbance of any other kind. So the important thing to do is to get your currency into assets that appreciate at least at a pace with inflation or greater. And Michael, I think I have this right. Your true appreciation is that difference between the increase in value less your inflation. That is your actual increase in spending or earning power.
Right.
And so I want to say that again, just to make sure people understand. If you put your money into an asset that's making 4%, and you're like, wow, my bank account is offering a lot more than these other bank accounts are because I'm getting 4% on my money. But let's say inflation is sitting at around 3.5, 3.75. So you're really only making 1/4 to 0.5% on your money. And when you're talking about growing wealth, that's not at all sustainable for building something over a lifetime that you can not only enjoy in retirement and then pass on to your heirs. So that's when people start engaging in riskier investments to account for that. And what you need to do is when you're investing in the riskier assets, you seek wise counsel. That's one of the reasons I find Michael Ross such an asset. I invest in real estate. Now, I invest in a few other things that are slightly riskier, but the real estate makes up the biggest portion of what I invest in. And some people think that real estate is a risky investment. If you don't know what you're doing, if you don't bother to learn, and you don't seek wise counsel, then yes, it is. But I am very happy with how the real estate is adding to my wealth, combined with wise counsel and constantly learning about the industry. So like I said, you put your cash that you get into an asset that will appreciate or provide some kind of monetary return. I hope I've done that clearly. Sometimes my head is spinning faster than my words are getting out.
I just wanted to mention, if I may, so what happens when there's a lot of inflation, and right now inflation is at 7 to 8%, and that's a lot. But it was actually worse back in the late 70s, it was 20%. But what happens with inflation is that people don't want to sit on dollars because those dollars are depreciating in value. So what happens is in inflation, an inflationary trend, people spend money immediately so that they can buy the goods at the cheapest price, knowing that the goods are going to likely go up in the very near term. So people are constantly consuming in inflation, and all that does is just make inflation worse because they're just continually bidding up the price of goods. So it's kind of like a vicious cycle, you know? And so what do people invest in? What is the best investment? Best investment is actually real estate in periods of inflation. And I'll go back to you, Julie, now.
No, thank you, Michael. It's a great investment in periods of inflation, but it's a great investment with judicious approach pretty much through all markets. You find you have to be open to different kinds of strategy in real estate. And just let me, I know Shamir's in real estate. Tiffany, you're in real estate. Wilda, are you in real estate as well? And then
yes, I am a realtor as well.
You're a realtor. And then Joel, I know, has some investment property. So here's where I really like to see people change their mindset. It's funny to me that when qualifying for a loan, they ask you for your assets, but they qualify you based on your debt ratio, income to the expenditure of the house. Very few times is there a lender saying, oh, well, your debt ratio on your income looks kind of high, but look at all those assets you have. And we'll just qualify you on assets. So as a result, there's a push, I feel, for most people to have high income so they can qualify for these high dollars that they're earning, rather than building assets that have returns. Those returns can finance some of the things that they're acquiring. When that hit my head, I was like, wow, we need to concentrate on assets. That's how you build wealth. And by assets, I don't mean things that depreciate in a short amount of time. And what Michael said about that runaway inflation, I do remember that. I'm old enough to remember the inflation of the 70s and the savings and loan failures. Was that the 80s?
Yes.
In Colorado, it hit like the 80s. And as a result of, in the 80s, I bought my first real estate property in 1983 for $24,000. And it wasn't a lot of money back then either. It was a condo that had been built, this huge complex made. They were selling for about 70, so they were pretty nice. And then there were lots of foreclosures and they couldn't give those things away. And so I was able to get one of them. And to tell you how fast things can rebound, I sold it 2 years later for 50. So that's when I was like, wow, you can do some money with this. Now, that's when I say that's how real estate as an asset class can help grow wealth. Now, just think about if I hadn't sold that property that I bought in 1983 for $24,000, if when I was done living in it, I had said, you know what, I'm going to make this an income producing asset. I'm going to find those professionals that can help me, a good tax strategist and a good property manager in that case. If I had kept that property, I don't even want to tell you what that condo is worth now and what the rents are going for now, because that condo was near a world-renowned resort called the Broadmoor, which growing up in Colorado Springs, I didn't give that much consideration to, but now it's an important destination. You have to be forward viewing. If there had been somebody like Michael advising me back in the 80s, when I was like buying, selling, bought a bunch, sold a bunch, before I became the buy and hold person, I would have a nice little real estate portfolio still sitting in Colorado where the property values have gone completely through the roof. I grew up in a small town of Colorado Springs. It is not, and the prices were quite low, and they are not anymore. So when it comes to building wealth, if I had had the proper counsel back in my 20s, I would have an extra little boost to my portfolio. And so one of the reasons I started Pitranomics is to build the community so people don't have to follow in the same mistakes that I've made or that others made. Let's share the wealth so people can do greater things. And one of the wealth points that I really want to focus on, I don't know, there's my camera. I really want to focus on is you have to have wise counsel. You have to have someone competent in the areas that are helping you, whether they're the fun, exciting areas or not. I was not attending to my books and my taxes in a strategic way before I met Michael. I was doing well in a lot of ways, but I didn't really know how I was doing. And Michael has helped me become a lot more disciplined about that. And that in itself is a wealth building point right there, because I bought a property and I'm now seeking to get this huge loan on it. Well, they need a history of showing that you're able to take on that loan. They need sound financial documents. They need to know you're up to date and compliant with your taxes before they loan you huge amounts of money at low rates. You can always borrow huge amounts of money at high rates. That's that expensive thing. So I'm really glad that I met somebody like Michael. I met him through a really horrible experience. I know some of you know, but I was in a lawsuit. I sued some former business partners, and somebody had to go in there and try to figure out what had happened with the money, and that was Michael Ross. I don't recommend getting into a lawsuit. It's very unsatisfactory as far as what you get when you go through this very long process. So I just think that in order to, and I'll answer any questions about that later, but I just want to make sure Michael can talk about the value that he can provide to building wealth. So in the Pitranomics segment, there are two parts there. There's the one where you get the professional help, maybe three, that's the wise counsel. There's that you pay Uncle Sam what he's due, and as far as I'm concerned, and no more. And then also, Michael's become a strategic partner, so he's in my lifeboat, helping me and my business to go forward, not causing me to sink. So when you think about it, if you adopt a strategy for growing wealth, getting the right people in your life, making sure they can do the things that you need for them to do, that is number one wealth growing tip right there. And in the Lifeboat series later on, I'll talk about partnerships, because divorce is expensive. Divorce is catastrophic to growing wealth. And Michael mentioned, right, that you do a lot of forensic work in the divorce specter. So when you think about that, he said there's an opportunity. There's a lot of people getting divorced and they decimate their finances. So, and they decimate themselves emotionally and generally also their families. But if you get past that, if you concentrate on the finances, I always say the choice of a marital partner is the single most important financial investment you'll ever make. Go into it wisely and sagely. But if you have to get out, make sure you seek wise counsel. And that's someone like Michael. And I know I've rambled a bit, so I'm going to give it back to Michael. One of the questions that I've seen here is what changes in interest rates can we expect within the next 6 months?
So I will try to put my magic hat on, and no, actually it's the Federal Reserve. Jerome Powell, who's the chairman of the Federal Reserve, has given, the Fed is pretty transparent with respect to rate hikes, but the market expectation is that rates are going to go up 5 to 7 times over the next 18 months, 18 to 24 months. And they're going to be slow. It's going to be 1/4 point. If the economy is still overheated, they'll increase it from 25 basis points to 50 basis points. So they can also sell more of securities, like mortgage-backed securities. They can put that back into circulation, and that will decrease the money supply. So the Fed has a lot of tools to slow the economy down. You know, what'll happen is we're going to start to see mortgage rates go up 1/4 point here and there. So that'll slow down real estate a little bit. Right now, the housing situation is such, single family housing market, and Julie might be able to speak better to this, but it's a very tight market right now. It's a seller's market, and that means that buyers are basically, in many cases, overpaying for property right now. But it just, the problem is it's a supply and demand issue, and there's just not enough housing. And it even has gone into the multifamily market as well. Not only single family homes, but multifamily properties. It's hard for people to find apartments and affordable rents. It's crazy. So anyway.
And one of the things I want to mention about housing scarcity, and I've talked to Shamir about this quite a bit. I really believe it's an apparent housing scarcity. People are looking on Zillow for homes. People are using realtors to go through MLS for homes. For those of you that are realtors, please find an investor that does renovations, that finds distressed properties, and partner with them to find homes for your buyers. If someone going into that venture know they have a qualified buyer on the end ready, because it doesn't take that long to flip a house, really. It shouldn't. My former business partners seem to take over a year, but you know, that said, it shouldn't take that long to properly do a house. And if they are spending months looking for a house, well, and I've told Shamir I'd really like to do this, let's find a buyer that's solid and get their criteria, and I will find them a house in their zip code, and I will renovate that house for them. I think it'd be a fun thing for Shamir and me to do together. And the rest of you should find qualified investors, learn how to determine whether the work is done well or not. I would be very transparent. Some renovators are not about what's going on in the house. That's a way to at least help your clients find a house. And then they will think you're awesome for finding them a house in this crazy market. But I do think not only is supply important, but channels of supply. Learn to look at other channels of supply in a time where one channel is tight. One of the things I have been doing for about 20 years now is I love to go garage sale shopping. And I have furnished my house and my office with garage sale finds. And it's just amazing to me what people get rid of. And so some of the things that people would spend, I would say 10 to 20 times or more what I would pay for it. It's unfathomable to me that they would pay this money and then get rid of this item within a year or two. And so I would go behind, you know, I'm not too proud, and I will get that and I will put that in my pocket. And that's kind of how I view about houses. People don't take care of their houses. They get a house, they don't take care of it. Okay, I'll come in there and take it. I'll fix it up and I'll make it into an income producing asset. You as realtors can use that partnership with people like me, maybe not just me, but people like me, and help your buyers find a house. Those ones that have sent in, I don't know, 15, 20, 40 offers. If they're, I know one friend told me she put an offer on a house and there were like 50 offers on one house. I would just stop. I was like, surely there's another way. Surely there's another way. And there is. And so keeping aware of what your alternatives are, which is how I got back to this, is an important part of circumventing all the noise and being consistent with your plan to grow wealth, which is what I try to do. I don't want to look at all the noise of what people are doing. I want to grow in a way, it's like, oh, there's this path over here that's perfectly fine. And every time I'm considering something new, since I've met Michael, I've run it by Michael. So, and he's given me his cautions. Now that doesn't mean I won't do it, but it means I've been a little more informed about going forward in that venture. And that's what advice and counsel is supposed to do. It's not to tell you what to do, it's to provide information so that you can make a wise decision. Enough about my rambling. Let's see, there's a question from Shamir. For new business owners who want to avoid coming to see you for your fraud and forensic purposes, thanks Shamir, what can we do to best ensure we stay on top of our business income and expenses, keeping them separate from personal expenses and reporting accurately on our taxes? Okay, great question. I love it.
So yeah, that is a great question. And I do want to talk a little bit about fraud and forensics type stuff. You know, yeah, I think probably the most important thing is you have to be careful who you do business with. I mean, I can't, you know, I can't say that enough. You know, if it's just you over the checking account, you know, you're pretty much going to be able to control what's going on there. But I'll give you an example. Let's say that you decide to buy a piece of property and you want to rehab it, okay? I think probably the most important thing in that rehabbing decision is the person that you pick to do the rehabilitation. If you pick a bad person, you're going to have a problem. The other thing is when you do a rehabilitation, you want to be careful about borrowing money from a from certain lenders that that do interim construction type financing. They're called hard money lenders. For example, let's say that you buy a rehab property and you figure it's going to take you 3 to 6 months to rehab it. Well, what happens is you establish a budget, possibly with a person that does rehabs, that does fix and flip rehab type work. You want to be careful that they don't come back to you with all these change orders, okay, that could just eat up your profit margin, And then the other thing is can you really afford to pay 11% for money and it takes you a year to rehab a property? I mean, the economics of doing a rehab can dry up very quickly with a bad rehab, with a bad, construction company and an expensive hard money lender. And I think we even saw some of that, didn't we, Julie, in some of your stuff?
Unfortunately, we saw a lot of that in some of my stuff. So
yeah. And so I hate to rub salt in a wound, but Julie has has definitely gotten some scars from what she went through. And a lot of it was out of her control. She went into it, and I hope it's okay for me to share this, Julie.
Not too much.
No, I'm not going to share too much. Yeah. I'm not. I'm just going to say that she had a budget. That budget went over. And it went over in two ways. One, materials, the other, length of time to complete the construction. And both those things will make a property become uneconomical, and sometimes uneconomical from inception. So just got to be very careful what you do there.
And that's, I would say that most people who go into flipping homes really do it so they can improve a property and make someone happy. I think that most people go in there with the best of intentions. But if you don't know what you're doing and you're starting to cut corners, you realize those cut corners cost you more than doing it the proper way. And then when you go over budget as far as time, like Michael said, the hard money lenders are like from 11%. Some are as high as 15%. That's over the year, and it's interest only. You're not paying down any principal. And so those costs can get really, really expensive when it comes time to sell. Well, you've got to settle all accounts, including the account with your lender, before you can clear that house to sell it to the next person. And that's why there are some corners cut. I think it's better just to make sure you establish like what I like to call the foundations. And I recently had a talk with a realtor that was helping someone do a renovation, and they didn't do an inspection, and they didn't address what I think are the fundamentals of the house, which are the roof, foundation, the plumbing, the electrical, and the HVAC, those big ticket items. You take care of that first, and then you take care of the cosmetic stuff. But you got to make sure your house is functioning. I believe that's the same about your finances and your wealth building as well. Take care of your fundamentals. Don't cut corners. Have a sound tax strategy. Have a sound spending strategy. I'm not saying that you have to be a perfect automaton and never mess up, because I do all the time. But since I have a strategy, I know where to go to get back on track. That's kind of what helps me. And one of the things Michael showed me, which is unfortunate, these partners that I was with, they were messing up from the beginning. So even when we were making money, there were problems in what they were doing. And so when things hiccuped a little more, the problems became that much more apparent. So when I was just doing my own, I didn't have these problems. But when I was doing it with somebody else, giving them control of the money and the budget and the schedule, then I had problems. So I'm like really sour on partnerships right now. I hope that I won't convey that too much because maybe some work, I don't know, but I will never do that again. What Shamir asked about how to stay on top of your business income. Michael, one of the things you have helped me do is to have that Chinese wall between business spending and personal spending. And I have a QuickBooks account. You have to set up something called a chart of accounts, which describes how each expense goes. I have personal credit cards that I use pretty much solely for business. And they're included in my accounts in my business. If there is an expense that's not business related, I do mark it. So I now have a very clear demarcation between business expenses, personal expenses, and all that I didn't have before, which helped me provide the route to get out of some of the problems that I had suffered as a result of the bad partnership. So I learned a very valuable lesson. I learned that I need to stay on top of my books. Am I perfect with that? No, I'm still about a month behind. But I'm in the process of getting financing. I have perfectly adequate financial documents to share. We had to go back, what was it, Michael? I think it was like 4 years of taxes. Yeah. We went back and recharacterized. So that's just to get me on the right path. And that took hours and hours and hours of work on my part and on his part. While I was doing that activity, I wasn't doing the other activity of acquiring properties and whatnot, but I was strengthening my foundation. So, Shamir, to make sure we answer your question, I recommend, and Michael, back me up on this, have a way of accounting for your expenses that clearly separates what's personal and what's business. Use business bank accounts, use cards solely for business, keep careful records, use wise counsel from a tax strategist that can help you make sure legally you're compliant with whatever you need to do. That work is not the fun and exciting stuff. It's not the stuff you can post on social media and say, look how well my books look as I go to apply for this loan. I don't know why that's not the fun and sexy part anymore. That's what really gets me going. I have learned to dig through things with Michael's help, and I've gotten to the point where I have my own opinions about things. Michael has provided me amazing counsel, but I'm now like, okay, I can do something else. The point being, I can knowledgeably do something now with that solid foundation. So I use QuickBooks for my business. I don't know if you have to, but it works for me because I use the online version. So my wonderful CPA in California can just log on and look at my books and we can have very sound conversations. So it's not a cheap tool, but it provides me an efficient way to get the wise counsel from my CPA.
Well, Julie, you brought up something very key. Real estate is a very capital intensive business. You have to borrow money, you have to have good credit, and you have to have funding sources, okay? Whether that be a bank, a mortgage company, or an equity partner. One of the things that is important at any time, let me back up for a second. One of the things that's, to be a successful entrepreneur, you have to be always looking for money, no matter what. As an entrepreneur, you've got to be looking for money. That's just part and parcel of it. In order to be able to obtain credit, you have to have good financial statements, and you have to demonstrate to a lender that you are in control of your finances. Hence, staying on top of your QuickBooks is critical. It's a critical factor for success, and as you grow, it becomes more of a critical factor for success. And not only is it necessary for planning purposes, but it's necessary for your financials to be timely so that you can be proactive in your investments. You know, and a lot of you are going to start out with one rental property, go to 2, then go to 5, then go to 10. You got to stay up on your books and records so that you have availability of capital. You're able to demonstrate to a lender that you can borrow money and pay it back. And I see that we have another question. What should one consider in deciding to start an LLC versus an S Corp? So one of the things about an LLC is it's a limited liability company. It is typically taxed as either a sole proprietorship, if it's a single member, single owner entity, or as a partnership if there's more than one owner to the LLC. An S corporation is similar to an LLC in that both the LLC and the S corp is a pass-through entity. In other words, there's not taxation at the entity level; it's at the individual level. I would say this, that in today's business environment, you're seeing about 80% of people do LLCs and about 20% of folks doing S corps. S corps have some limitations, which I won't get into too much of the technical aspect right now, but you have to, there's just more restrictions on an S corp than there is on an LLC. For example, a C corporation can't be an owner of an S corp. An S corp has to be owned by an individual or a trust, or another S corp. So you have to be careful how you use an LLC and an S corp, but they both pretty much get you the same thing, which is to avoid double taxation, once at the corporate level, once at the individual level. So hope I answered that question.
I would like to add that sometimes certain questions like what should you consider in deciding to start an LLC versus an S corp, some of that is going to depend on what you want to accomplish in your business and your reason for opening the entity. And so when you seek the professional, make sure you share as much information as you can about what it is you're intending to do so they can help guide you as to how to do it. And you have to give a thought to what it is you want to do. So one of the things I looked into when I first got my license was, well, I would like to be a licensed agent and get paid in my LLC. But in Texas, LLCs don't get licenses. Agents get licenses. Individuals, they work on behalf of a broker. The broker can, of course, open the LLC or whatever entity they choose to do because they have the right to buy property on others' behalf. As real estate agents, we have the right to act on the broker's behalf. So you don't have that bumping heads right there. Now, I do keep very separate my investing business, my coaching business, and my realtor business. So they're paid differently. If that's something that you want to do, then make sure you discuss that, think about it and discuss that, or get that nice initial consult. It's like, you know, I vaguely know what I want to do. What are your suggestions? Then go back and think about it. What is it that I actually want to do? And then start using those wise people to help you put in place what you've decided to do. So my take on that question is, it's very difficult to know if an LLC is better, if a corporation is better, if a partnership is better, without knowing the context of what it is you're trying to do. And I'm going to go back to my Pitranomics strategy for a moment. The first two parts, the first one is you have to figure out what it is you want to accomplish in life, and then take an assessment of what resources you have available to accomplish it. And then the second part is to develop the roadmap on how to do it. Now, it's a 10-part strategy. Those 2 parts you have to do first. All the rest of the stuff will just be gobbledygook until you decide what it is you want to accomplish, what resources you can devote to accomplishing those goals, and then determine what your roadmap is. And by resources, I focus on money, energy, and time, which are finite. No matter how much money you have, no matter how young you are, no matter how boundless your energy may seem, these are all finite entities. And once people, it's just without question, once people think about, these are my goals in life, I call them end of life goals, what you want to accomplish in life. Once you figure out what your resources actually are to put toward those goals, prioritization starts happening like that. That's one of the reasons why I can react quickly about things, because it's like, nope, that's not consistent. Yeah, I'll try that. Nope, 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 nope. And you clear out all the noise and you go forward optimally with what you want to accomplish. And once you have your roadmap, then it's clear how you're going to accomplish it. Even if you go off track, you can get back on because you know where you're headed. And that's why I feel like someone like Michael, you know, my goal was in partnering was to have these people build these beautiful houses that I could sell and that I could, you know, sort of fill my social media up with and still make money. Making money was still a very pivotal part of my intention with that partnership. And while I think they made pretty houses, they were horribly unprofitable for me. So they did not meet my goals. And when I realized how deep I was like, okay, time to get out. And then everything just fell like a house of cards because I hadn't been paying enough attention to what they'd been doing. I assumed they knew what they were doing. They certainly told me they did, but that was not wise counsel I was seeking. So in them, as a result of going through this process, I have learned a lot. So while I don't like the process I went through, it was painful. I do not want to go through it again. I don't want anyone I know about to go through it again. I learned so much from it, and I'm still learning, and I'm still applying. And I realized that you have to be really good at deciding who can help you, who has the competence to help you, who has the integrity to help you. And Michael is one such source for me because he, one, is a great CPA, but that by itself wouldn't be why he's so awesome. He's a great CPA. He has experience in forensic accounting. And Michael, I do want you to take some time to explain exactly what that is, because it's like juicy. And then he has a good real estate understanding, which is important if you're doing real estate. And he knows how to value businesses, so he knows what a business should have in order to seem valuable. All of these competencies in this one person, that's amazing. It's not sexy, it's not fun. It doesn't show well on social media, but if you don't do your foundations correctly, your business will crumble. If not today, someday in the future, and you won't be prepared to recover. So.
Yeah, I do want to, going back to that question, I'll talk more about forensics in just a moment, but I wanted to talk again about the LLC versus S Corp. I mean, one of the reasons why you want to even contemplate a corporation or a limited liability company is for asset protection purposes, okay? You want to have the ability to put an asset in an entity other than your own name, so that if something happens at that entity level, it doesn't affect your other financial assets. So what you'll see is, you'll see somebody set up an LLC for each property that they own. And let me say this, for holding real estate, the LLC is the most flexible and really is the ideal entity to hold real estate in. So just as I said, 80% of what's being done out there in terms of new companies are limited liability companies, and 20% are S corps. But S corps are really designed not only for asset protection, but they're very good for certain types of businesses. That's something that, you know, so you want to think about asset protection, you want to think about avoiding taxes, and then you want to think about maximizing your income. So anyway, I hope I answered that question. Let's talk a little bit about the forensics area. I think divorce is pretty clear. I mean, I do a lot of work in the divorce area, and it's interesting, and it's actually very satisfying, because you're actually meeting people and helping people that are going through a very bad time, you know? And one of the things that I strive to do is to it's almost cathartic for people that, that come to me to talk to me about all aspects of, of what they're going through. But one of the things that I think why I like offering services in this area is that because I think I give people a lot of hope. So not only is it cathartic, but it also gives people hope when they're feeling at their very worst sometimes. And at any rate, just wanted to throw that out to you. Some of the work, a lot of the work that I do is in the commercial forensics area. And that's where I have, let's say, a client that has a partner and the partner is doing them wrong, okay? They are controlling the cash flow. They're paying themselves more than than their pro rata share of their ownership. And so what happens is I come in and I have to figure out either what are the damages, how have you been harmed, and to what extent have you been harmed? And then I have to quantify that. And then the attorney does his thing with that. Attorneys aren't really financial folks, so they kind of rely on, us accounting types to come up with, what the damages are, and, they take it from there. But it really helps the attorney in administering the case when they have a sense of what the numbers are by virtue of an accountant being engaged to help them figure out what went wrong, where did the money go, what are the damages, etc. So that's usually how it works.
Whoops, there was a question from Facebook. How do you get the upper hand on other offers? And I've asked for a little more clarification on that. Hopefully she'll write back. But one of the things that I would kind of like to touch on, especially for people who are in business for themselves, and how a good person like Michael can be helpful, is depending on how much money you're making, you can be basically taxed out the wazoo. And it's important to keep careful books so that you understand what your revenues are, what your expenses are, what your net profit is. And from that profit, that's when you start going through whatever tax, I don't know what to call it, process to figure out what your responsibility is. For people who have W-2 income, that's already been done for you. This is what you've been paid. You have a document. You send it to your accountant. If you don't have many deductions, you can do what's called a 1040 pretty easily yourself. But our tax returns when printed out, I don't know, what about that thick, Michael? I mean, they're just pretty amazing. And there's the 1040, which is 2-page document, and then schedules and whatnot, which make the meat of what our tax strategy is and how it's implemented. There are 2 schedules, and Michael, I'd love your words on this. Schedules C and Schedules E, that every business person needs to study and know. So you realtors, know those as well as you know that 1 to 4. So you know how your expenses should be structured optimally. And we may have another Pitranomics class about that later for realtors, but it's really important that you print out, like right now, or any independent business owner, the Schedule C and Schedule E, and familiarize yourself and think about it. Sometimes, literally, this sounds crazy, I will just look at them and go, because I had an incident last year. Michael knows what I'm talking about. I had a property that seemed to be a little bit, well, it seemed to be profitable, and I couldn't allocate my overhead to that property to make the income look lower, and I got taxed on a higher level of income. Now, it's not a big deal. It wasn't a big deal. It wasn't a lot of money. It just annoyed me. So going forward, I'm going to be having those strategic discussions with Michael on how to make sure things look as they're supposed to look. You know, having a rental portfolio and not being able to apply your overhead across all of it, that's no fun. So I'm sure we'll figure something out for this year. But I don't know many realtors that look at their Schedule C and E and plan strategically in their business. So, Michael, if you care to explain exactly what those are and how important those can be.
Well, both Schedule C and Schedule E is where you report income and expenses, because your income less your expenses equals your net profit. Schedule C is really designed for sole proprietors, and typically single member limited liability companies report their income on Schedule C, their income and expenses on Schedule C. If you own rental property, you put your rental income and expenses, you report it on Schedule E. So Schedule C is sole proprietors, Schedule E is rent, royalties, partnerships, S corporations, etc. That's where that income is reported. So that's the basic difference. And, you know, Julie, in your situation, what we might want to look at is allocating that overhead to each property based on its revenue to total revenue. I think maybe, you know, we might want to go in that direction, because I think that'll help you on state and local, which is, I think, the issue that you were talking about, state and local taxation.
That was exactly what I thought would be an appropriate response, because, you know, I was annoyed. I thought, oh my gosh, really?
Yeah.
So, and realtors, when you sell property on behalf of others, I think it's almost like you have your hand in the cookie jar. Get some of those for yourself. You know, get 1 or 2. You come across so many, surely 1 or 2 could help your investment portfolio. And I could talk about that all day, every day. But Michael, do you have any advice for, and if not, I get it, for someone who's never had investment property, what steps to take, and maybe what steps not to take before getting investment property?
Well, you know, it really just depends in large measure on, you know, what you want to do. You know, do you want to be you know, do you want to start investing in real estate early on in your career or whenever? But I will say this, that real estate over the long term is an excellent way to increase your wealth. I say over the long term because In the short term, there's going to be ups and downs. And over the long term, if you want to do income producing real estate, you'll generate income, you'll pay off your mortgage, and the result will be that you're building equity in the property. At the same time, the property is appreciating in value. So you're also increasing your net worth that way. And it's not unusual for people that start out early on to ultimately have 20 or 30 properties, sometimes in as little as 5 years. You know, they'll will have gone from 1 to 20 or 30 properties in a 5-year period. More likely that's done over a 10-year plus period. But I've had clients that, I had one client that was in his 80s. He passed away and I had to work on his estate. He had 100 rental properties, 100 single family rental properties that in aggregate totaled about $20 million of net worth for him. And he did actually more low end type single family stuff. So he did smaller stuff that nobody wanted to do. And he just kept buying 100 properties, 20 million and his tenants paid for all that real estate. And he enjoyed you know, significant upside and cash flow. But you have to structure things right. You have to go slow. You can't get ahead of yourself. And, you know, anybody can do it. And, you know, everybody starts with one piece of property and they go from there. So good luck.
You know, I'd like to share, I'd like to share the story of the first property I bought in Texas. So I started investing in Texas in 2015. And I bought this property. The rehab budget I was given was, I ended up doubling that rehab budget. So if we go back to people starting on a limited budget using hard money, that would have run that person in the trouble. Luckily, I wasn't using hard money. And because it went over budget, it also went over time. But luckily, when Michael says real estate is great in the long term, I agree, it's very forgiving in the long term. And so that property, my first property that I bought in 2015 that went over budget, and I was literally thinking, oh, this is going to be a horrible process. I'm going to get out and never do it again. I had a mentor that came in and looked it over and said, no, that's good. Keep going. You're still good. You're fine. And that was encouragement that I needed, because I was really thinking about just dumping it and taking the loss and moving on. Now, these years later, I still have the same tenants that moved in 2015. It's been an awesome moneymaker, and it has appreciated up the wazoo. It's a property in Grand Prairie. So if you take the long-term approach to business, and you should, Michael, you talked about that earlier, people being very short-term focused. If you're starting a business and growing a business, that's a long-term endeavor. So start your foundation right and be diligent and consistent in what you do. And then down the road, 10 years, 20 years, you will be like, wow, that's amazing. Look what's happened. But you can't take the short-term approach to that. You can't constantly be cutting corners. And one of the reasons I'm really happy with what I've accomplished is I've had some great mentors and people from whom to seek counsel. And that's been my mindset all along. The aberration with my former business partners aside, I have been blessed with very sound advice givers. And so one of those is Michael. We met 3 years ago, Michael, 4 years ago. So it's been really great. He advises me to be prudent in my endeavors, and so I appreciate that advice. Awilda said she's printing those forms now. That's great. That's great. I think every realtor should have some real estate of their own. some investment real estate of their own, because you're in the business. Why not? And you know the business, so why not? And look at those forms, and maybe one day we'll just sort of discuss those forms like in a free open question forum. If Michael can come back, I know he's very busy, so I thank you for your time now, but it's very important to understand the schedules that go in helping make your tax return. And that document, that 2-page document, takes a lot of work to get it where you need it to be optimal in your business. So Michael, I mean, thank you so much for sharing your gems. Are there any questions, any more questions or comments that someone would like to share? Go ahead and unmute yourself if you'd like to say something.
I will put my name and phone number in case anyone would wish to speak to me offline, and look forward to answering any questions that you might have.
Michael, I just wanted to say thank you for the information that you've shared. I did have an opportunity in my daytime job to use a forensic accountant. And so I was so excited that I actually knew what that meant when I got on the call. So thank you so much and have a good day.
Thank you, 𝗏𝗏. Very nice to hear from you and talk to you. Talk to everyone. It was great. Thank you. Thank
Michael,
you, everybody. Appreciate it.
Thank you so much. Thank you, Michael, for coming and sharing your insights. Thank you guys for your questions.
Thank you.
And
we'll talk to y'all soon. Take care.
Yes, we'll talk soon. And Michael, congratulations on your new
thank you, Julie. Thank you so much. Thanks for all your kind words. Always appreciated. Take care. Bye-bye.
Bye.